Have you ever wondered how you can find stocks that can deliver 10x returns and beat the market over the long run? Well, every year tens of thousands of investors try their luck finding so-called alpha generating stocks, but most fail in their attempt to beat the market and would have been far better off simply investing in a passive index fund. But if you are truly serious about reaching your financial goals more quickly than you would be by indexing, I recommend focusing exclusively on identifying high quality and reasonably priced businesses. But how can you spot these businesses? Well, generally I think most statistical approaches to assess business quality and most valuation multiples to determine whether a stock is attractively priced are fundamentally flawed, as they often miss the bigger picture and ignore qualitative factors such as the integrity of management teams, for example. However, I've recently come across a more complex statistical approach, a formula which I call the 10x potential formula that may help you identify high quality businesses trading at reasonable prices more quickly. And today we'll take a look at the four components of this formula, and I'll explain how you can use it by looking at a couple of well-known businesses, including Apple, Google, and Tesla. So without further ado, let's get started. Hello fellow intelligent investors, my name is Avner Mandelman, and I would argue that knowing how to properly value a stock and knowing how to identify above average companies in terms of their quality is the most important skill an investor can have. And of course, in the world of investing, you will come across literally hundreds, if not thousands of different approaches to do exactly that. For instance, there are all sorts of shorthand valuation methods, with valuation multiples being the most commonly cited approach. I'm sure most of you have come across terms such as PE multiples, price to sales multiples, or price to book multiples. Put in a nutshell, those valuation multiples are really just shorthand versions of their longer and more complex cousin, the discounted cash flow analysis, or short DCF, which most certainly is the superior approach. If we just consider the price to sales ratio, for example, we can highlight some of the problems that come with valuation multiples. The price to sales ratio, for example, ignores profitability, so profit margins. Higher profit margins would justify a higher price to sales ratio. It ignores future growth because, after all, assuming all else equal, higher growth justifies a higher multiple. It ignores the financial leverage of the business, which is just a fancy way of referring to the business's levels of debt. Higher levels of debt should of course result in a lower multiple. And finally, it ignores the skill of the management team. Again, a higher skilled management team would justify a higher valuation multiple. One valuation multiple that solves at least one of the problems is the PEG ratio or PEG ratio, which was popularized by Peter Lynch. Essentially, the price to earnings to growth ratio is a modified version of the PE ratio and also takes earnings growth into account. And in the formula that I will share with you today in this video, I will deal with three more problems of the price to sales ratio. Essentially, the formula consists of three variables in the numerator. They measure the business's quality, and one variable in the denominator to take into account a stock's valuation. So let's break it down. The first two variables of the nominator are basically derived from the rule of 40, which is a common rule of thumb to analyze the health of software or software as a service companies. It takes into consideration two of the most important metrics for these businesses: growth and profitability. So you simply add the percentage growth plus the EBITDA margin to calculate this metric, the rule of 40. And the idea is that a software company's combined growth and EBITDA profit margin should be greater than 40. So for example, a company can have 20% revenue growth and 20% EBITDA margin, 0% revenue growth and 40% EBITDA margin, or of course 40% revenue growth and 0% EBITDA margin. Thus, some businesses may sacrifice profitability to grow, while others may be extremely profitable but may have underinvested and growth. Now for our 10x potential return formula, we are going to adjust the Rule of 40 formula a little bit. We'll also measure the growth by looking at a company's revenue growth, but instead of just looking at a single year, we'll use the firm's 3-year compounded revenue growth. And instead of a company's EBITDA margin, we'll consider gross margin. Then we are going to add the third variable to the numerator, which is return on capital. And then finally, you are going to add them all up, and that's basically our quality score. So a company with a gross margin of 25%, revenue growth of 5%, that is earning a return on capital of 10%, would have a quality score of 40%. Now, generally, I would argue that companies that have a score above 80, they deserve your attention because there is a high likelihood that you are looking at an above average business. And those businesses with a score above 100 are most certainly truly exceptional companies. So that's the numerator. As we said at the beginning of the video, to do well in investing, you need to focus exclusively on both identifying high quality companies and reasonably priced companies. So what we will do next is we will take a look at the denominator and we will include a valuation multiple. We are going to use enterprise value to operating profit. So by using enterprise value, we are also taking into account a company's debt level. And yeah, that's our final formula. Now to find interesting opportunities, I recommend looking for companies that end up with a total score above 5 or even 6. Now before we take a look at actual stocks, actual companies, to illustrate how exactly this approach can be applied in the real world, I want to give a quick shout out to Avner Mandelman, who recently appeared on the Investing by the Books podcast. And during this episode, he shared a very similar formula and called it the exceptional companies indicator. And this is basically what inspired me to come up with my own formula and to create this video. All right, before we now take a look at 12 different companies, I want to encourage you to do the calculations yourself. Just consider one of the companies in your portfolio or one company that you are currently interested in and do the calculation for this company. And then please share both the quality score of that business and the total score in the comments down below. To find the inputs needed, I recommend the platform ticker.com, on which you can find all of the metrics that you need to put into the formula, except for the 3-year revenue growth rate. So either use last year's revenue growth or calculate the compounded 3-year revenue growth yourself with the help of a compound interest calculator. And if you struggle to get your hands on some of the inputs needed for the formula, feel free to ask for help in the comments down below. So if we now consider Tesla, for example, Tesla posts a gross margin of 25.3% and a return on capital of 16.1% in the most recent fiscal year and grew its revenue at a compounded rate of 35.8% annually over the past 3 years. And due to its fast growth, the quality score for Tesla is actually quite good with a score of 77. But once you factor in Tesla's current valuation, the stock becomes much less attractive and would not pass our screening test. Next up, let's consider the arms and defense company Lockheed Martin. As the business ends up with a quality score of 53.7, you could essentially stop right here. And even if you factor in its current valuation, the stock doesn't become more attractive. And then lastly, let's consider a company that we all know is of exceptional quality, Alphabet or Google. Google achieves an incredible quality score of 108, and the stock even seems to trade at a reasonable valuation, which certainly makes it seem as if Google might be interesting here. And just for full disclosure, I've owned Google shares since the pandemic lows of 2020, and before investing in any stock, of course, you always have to do your own research and due diligence. I've actually looked at more companies, 12 in total, and here's how these businesses performed in terms of their current quality score. And once you factor in their current valuation, the ranking looks like this. And again, I would love to add more companies and their final score to that list, so please drop your calculations in the comments down below. Okay, just to be clear here, this approach, this formula, of course, is not perfect. It's a rather superficial way of looking at companies, as you cannot really screen for unprofitable companies that are reinvesting the majority of their profits back into the business. Just to give you one example. I would say generally, once you spot a business with the help of the formula that appears to be interesting, this is just a starting point. And of course, you need to do your own research to figure out if you really want to own the business. Personally, I still perform a DCF model to value every business I invest in, as the value of any asset should reflect the value of all future cash flows generated by that asset. And in our formula, we only considered past growth rates and not future growth. So if you want to learn more about this valuation technique, I recommend you watch the following video next. Take care.